Good afternoon. Good afternoon. It's Monday, the 19th of May. My name is Silan Wickramasinghe, Head of Research for Maybank Securities here in Singapore. And welcome to another edition of Monday Market Picks. Now, Moody's has finally joined the bandwagon with the other two credit rating agencies in downgrading America's credit. This is introducing some uncertainty to the markets, but at the same time, we are seeing a de-escalation between US and China in terms of tariff tensions. So which way do we go? So that's something that we're going to focus today in our show, as well as some key sector and stock picks as well. So we're going to start with economist Erica Tay joining us with the latest views on the trade war and what it actually means to China and to ASEAN. We also had some very strong results from Sea Limited. So we're going to talk about what that means to our buy call. And Jarek is joining us to discuss why he remains bullish on SingPost despite the recent results, as well as CSE, and also why he's bearish on AEM. And finally, we've got Samuel Yin joining us to talk to us about Genting, Singapore, and why he thinks that the second half is going to be very, very special and very strong for this stock. Plus, we've got our chart guy with a couple of new trading ideas as well. So without further ado, let's go to Erica. Erica, welcome to the show. Now, I want to begin with this tariff deal that China and US reached last week. Now, I'm confused. There's been a lot of discussions, depending on who you read, where you read, in terms of different tariff numbers being thrown around for both sides. So can you clarify what the effective tariff rates are right now for the US and China? And let's start from there.
Yeah, good afternoon, Thilan. We're having a bit of a moody Monday, I see. So for the US-China trade war, yes, indeed, the tariffs on both sides have come down. So China has reduced its retaliatory tariffs against the US from 125% to just 10%. And the US has also cut its tariffs against China by the same quantum, so from 145% to now 30%. Why 30%? So the argument goes that the 20% were tariffs that were imposed on Chinese goods because of dispute over fentanyl exports. So that stays. And then the 10%, America says that that is the rate that everyone enjoys. So that is as good as it gets. But effective rates, taking into account all those goods such as electronics that are exempt, we are looking at US tariffs on China going down from 90% to effective 43%, Dylan.
Okay, good. That's very, very clear. So at least that's one confusion off. But what does this mean in terms of the prospects for global recession and also for Chinese growth?
So I think first things first, I think the chances of the US falling into a recession were very high before this Geneva deal, and now that has come down a lot. So I think the chances, but by virtue of that, the chances of a global recession have also come down. And we think that, you know, if the 30% on Chinese goods would hold until the end of the year, we are looking at possibly upgrading China's GDP growth back to pre-Liberation Day, so 4.5% for this year.
Okay. Now, what does this mean for ASEAN? Now, you know, we've had this de-escalation. We also had an earlier deal with the UK and the US. So how should we read in terms of the prospects for ASEAN and who's actually in the front of the queue when you think about the ASEAN countries, and who's in the back of the queue?
Yes, Dylan. So among the ASEAN countries, not everyone has the privilege of negotiating with the US so far. And even if they do, not everyone is in as strong a position as China to get what it wants. So from what we know, the US has prioritized negotiations with about 20 countries. So these include its major allies such as Japan, Korea, and the European Union. But also in the mix are Vietnam and Malaysia and Indonesia, which run quite significant trade surpluses with the US. And then we have countries such as Thailand and the Philippines that are only starting to initiate talks right now. And then we have Singapore, which is not seeking to lower the overall tariffs because it's already getting 10%, but it is trying to get have its pharmaceuticals be tariff-free, Dylan.
Got it. Now, so far we only talked about the country tariffs, but there's also the sector-wide tariffs that the US has been talking about, particularly when it comes to pharma as well as chips. What are we expecting here over the next few weeks or months? And what does that mean to Singapore, especially given the fact that Singapore does export quite a big chunk of pharma and chips to the US?
Yes, indeed. So the Trump administration has sort of hinted that it will impose sector-wide tariffs for chips as well as pharmaceuticals. So it doesn't matter which country you are, those exports will see the same tariffs. So that will be quite damaging to the interests of countries such as Singapore, Malaysia, Thailand, and the Philippines that are quite dependent on either chips or pharmaceuticals or both. So we are awaiting news, but we are hearing that these tariffs could come in somewhere in the region of 25%, Dylan.
Got it. And then finally, Erica, before we let you go, we also saw the Trump administration adopting new AI rules, replacing the Biden era AI diffusion rules. What can you tell us about that development and how does that impact our region?
Yes, so this has to do with computing power. And so in the previous US administration, they designed these set of rules to restrict American advanced AI chips from being too concentrated in a certain foreign market. So these rules were supposed to take effect on 15th of May, but the Trump administration has since abolished those rules and come up with pretty much a country-by-country basis of negotiation. So we saw that Trump's recent visit to the Middle East actually yielded two deals. One to sell a lot of AI chips from NVIDIA to Saudi Arabia, and then the second deal to sell to the UAE. So previously under the Biden administration's rules, these countries would not would be subject to this cap of 7% of a US corporation's computing capacity. So right now, it seems that the rules are no rules. So it is up for each country to negotiate with the Trump administration separately, Dylan.
Got it. So still a bit of confusion there. Okay, thank you, Erica, for joining us and taking us through that. Now, before I go into stocks, there is a question from AI Tan asking, trade tension seems to be cooling down. Does that make banks look like a good bet again? I think if you look at my view, we are still very neutral on the banks. I think, you can't go very negative on the banks given the sort of weighting that they have on the Singapore index. But this won't make me more bullish. And the reason is we haven't seen any major upgrades to economic outlooks for any of the ASEAN countries, despite trade tensions easing. And I think we also have to remember that just because, we cannot just assume that the last thing the Trump administration says is the thing that they're going to stick to. I think there's still going to be a lot of uncertainty around in terms of economic policies, and that's going to drive companies and customers to keep their powder dry and not make decisions, and that's going to drive loan growth down. We are already seeing interest rates, despite the fact that the Fed holding interest rates high, domestic rates, things like SORA coming off quite aggressively, and that's hurting margins. And we are also worried about asset quality. And I think when you have this much uncertainty, asset quality is something that starts to raise its head. And we haven't seen a negative asset quality cycle for a very, very long time. So that worries me. So I think, we'd be a little bit more cautious on banks. The only bank we like in this sort of environment is DBS, given the yield support and also the Singapore Inc. premium. But even there, upside is fairly limited. So we have a hold rating on that. Now, with that, let me move on to a buy rating, and that's C Limited. The company reported a very strong set of first quarter numbers with adjusted EBITDA rising around 2.5 times year on year and about 60% quarter on quarter. Of course, Chinese New Year and Lebaran festivities in first quarter helped raise the base for them, particularly in terms of gaming, because a lot of kids were on holiday, and also e-commerce as well, as a lot of shopping happened during this period. Some of this will soften going into the second quarter, but we do see multiple levers to boost momentum for the rest of the year. Some of the very strong e-commerce monetizations that we saw in the first quarter, the company might plow them back in the form of campaigns such as shipping subsidies or higher marketing expenses to drive even more GMV growth. Plus, their new game, Free City, is set to launch in phases, and initial testing shows that this game is going to be a pretty good success. So we've actually increased, Hussaini, our analyst, has increased our forecast, EBITDA forecast for 2025 to 27 by around 6 to 8%, and raised the target price to $186 from $174, and we are keeping a buy rating on this stock. Now, with that, let's turn to Jarek, who's joining us. Jarek, welcome to the show.
Hi, Kiran, thanks for having me. Yep.
Good to see you. Now, we've seen you keeping a sell on AEM. So let's start there. Now, before we go into the thesis, can you catch us up on what disappointed you in the first quarter results?
Sure. So if you look at the first quarter results, revenue actually dropped close to about 60% Q on Q. 35% Q on Q. And net profit is dropped about 77% year on year. So the net profit is only 3.3 million. It forms only about 16% of our forecast. So way below ours and also consensus forecast. And I think for us, we expected slightly better results, or rather a slightly better forecast. So management is actually keeping guidance for the second quarter that shows that basically, first half is a bit slow, and the only uplift will come in the second half.
Okay. And how is management guiding now, and how does that look for outlook?
So they are guiding that the first half they are keeping their revenue target of about 155 to 117 million for the first half, which shows that basically revenue is for second quarter is slightly to be on par with that of the first quarter, which will be quite slow. I think for them to meet our numbers or consensus numbers, the second half numbers got to pick up more significantly, because I think they are guiding that second half they'll have other new customers ramping up their products. So second half revenue should be better. But for now, they are guiding that first half is actually quite similar to the first quarter, quite slow.
Okay, so if not AEM, what should we look at in this sector?
For me, my topic has always been Franken. I think after the tariff situation, where the stock price actually corrected 1+ month ago, Franken and Franken has actually outperformed its peers in terms of share price from the low, right? And I think Franken's going to release their numbers, I think either today after market or tomorrow morning. And I think that, you know, with their numbers, their share price should continue to outperform its peers because of its lowest valuation and also its earnings growth potential.
Got it. Got it. Now let's turn our attention to SingPost. And I've got the same question as Jeffrey Tan in the audience. He's asking, is it still a good buy? Is it still a good buy on SingPost? Now you have kept a buy on the stock, but we did see the stock getting a bit hit after the results. So what do you think? Why do you think the market is reacting this way?
Okay, I think firstly the core numbers were very weak, eaten into losses. So I mean, we expected the numbers to be very weak, but I think losses caught everybody's by surprise. But basically, I think, yeah, that was one of the main issues. Secondly, I think the special dividend was slightly less than expected. I think we expected 10 cents. They gave 9 cents. And also they removed the ordinary dividend because the second half was loss-making. That amounts to normally about 0.5 cent. So I think because of these two reasons, the stock price took a hit. And lastly, also, if you look at the stock price in the last 3-4 days, trading days before the results announced, I think the volumes were huge. Price actually went up significantly. So I think a lot of event-driven funds hopped in to buy. And when the numbers came out and the dividend disappointed, they quickly sell. So that resulted in the negative price movement. Yeah.
Okay, but how should we think about the stock now, given the fact that it's got a buy and a pretty good target price upside as well?
I mean, I think that the stock is still a buy in the longer term. I mean, in the short term, catalyst will be less because the main catalyst is over. And also there's a reshuffling of the board because 3 or 4 of the board members all hit the 9-year term limit. So we have to wait for that before the new direction is set by the management. I think they are conserving some cash so that they can have some leeway in terms if they want to buy businesses or invest in current businesses. I think the strategy as informed by them will be only out in the next 2 to 3 months when I think before the AGM, when the new board comes on board. And I think that basically strategy is still ongoing. Asset monetization is still ongoing. I think they are looking to still sell non-key assets like Singapore Center and also their post office network. Some of the post offices that they own, they want to reduce the size to actually cut costs. And I think those monetization plans will carry on. And cash will come back to pay down debts and then also return excess cash to shareholders.
Got it. So basically stay the course. Now, very quickly turning to CSE, I mean, the stock's already up about 10% and you still have about another 30% or more upside on your target price. What's driving your bullish view here? And is this Singapore's Trump stock?
Yes, I think if you think of it, in the longer term, or what's happening in the US, I mean, Trump wants to bring all the companies, all the production factories all back to the US, or at least he's trying to. And I think, we have seen many companies committing billions or trillions of dollars, big numbers, to build factories and production in the US. So I think that I don't know whether all these numbers will come true, but, I think the companies have to at least do something to pacify Trump or show that at least they are building 1 or 2 factories, right? So I think if you look at what CSE's business model is doing, they're doing automation for factories and also for other government agencies. They're also doing electrification and they're also doing critical communications. All these 3 fits into what Trump is actually promoting in the US. And also he wants to increase production of oil and gas in the US. CSE does that. He wants more data centers to be built in the US. CSE has booked into the data center with 1 client and another 1 or 2 more in the qualification stage, right? And then next is bring all the production of factories, which is actually what CSE does in automation as well. So I think all in all, I mean, I'm not saying that CSE will get a lot of the market share. I mean, currently they are only a very small player in the US, right? But basically what Trump is doing is, every angle is actually benefiting CSE. And on tariffs, because they have local production, they are expanding their US facility by 4 times in the next 2 or 3 years. Only 10% of their products are being shipped from Europe and other countries, which is impacted by tariffs. But other than that, I think, they are actually in quite a good prime spot to benefit from this move. Okay.
Great. So basically, I think a good proxy to ride the Trump wave out of Singapore. Okay, thanks, Jarek, for joining us.
Welcome.
Let's move to Samuel. Samuel, welcome to the show. So Samuel, you've got a buy on Genting Singapore. The results for first quarter was in line, but you're saying that the prospects for this stock is quite bullish. So what's actually driving your confidence?
Right. Hi, Dylan. The most important thing is that the overall gaming market in Singapore is growing. Singapore is one of the few gaming jurisdictions whose gaming revenues have actually surpassed pre-COVID levels. If you look at both major metrics, the VIP and the mass market, they continue to grow Q on Q since the first quarter 2024. Now, to be sure, Marina Bay Sands has gained more than Genting Singapore, due largely to its room renovation program. You can see a lot of videos of it in TikTok, enabling it to gain market share. Yet, Genting Singapore is also doing some room renovation of its own. The former Hard Rock Hotel will be rebranded as the All Suite Laurels Hotel and reopen in the third quarter of this year. And this is especially important because this will add to room inventory and allow them to house more VIPs and premium mass players. So Genting Singapore ought to be regaining some market share from the quarter onwards and hopefully report better earnings going forward.
Okay, so better market share with new hotel capacity all coming through. How does all this China trade war tariffs? I mean, we've always had this question on whether the Chinese VIPs will come to Singapore. How is that playing out? Do you see any concerns there?
It's hard to say at this juncture. We in the gaming analyst fraternity have been looking at Macau numbers very closely since the trade war started. And so far the consensus is that the trade war did not have a material impact on even Macau's gaming market, which one would believe will be the hardest hit from a trade war, but we have not seen that happen yet. From our understanding, Chinese VIPs contribute about 20 to 30% of Genting Singapore's gaming revenue, and even then, most of it is from the low-margin VIP market. And personally, I've never liked the Chinese VIP market in Singapore because not only are the margins low, they are also very susceptible to bad debts. So you have cases where the Chinese VIP market in Singapore can actually be loss-making. But even if half of them, would be lost, the impact of earnings, I believe, would not be too large. Again, margins are low and bad debts are high. And speaking to management, they said that they have already been curbing credit extension to Chinese VIPs even before the trade war started. So, assuming this trade war starts again, we don't expect a major leg down in their earnings. Got it.
Okay, so basically we should be watching out for third quarter results as a catalyst and kind of getting in before that. Is that the right sort of timing to look at for the stock?
Yes, I would say so. If I may say something, I think that the leg down after the results was a bit overdone. I believe that it has something to do with the management changes. But I cover the entire Genting group, and I would say that Genting Singapore is the last Genting to have its management change. We have seen management changes in Genting Malaysia even before pre-COVID times. There was a change in the Resorts World Genting head. Recently, there was a change in the Genting Malaysia CFO, and there was also a change in the CEO of Genting Berhad, the parent company of both Genting Malaysia and Genting Singapore. So this management change in Genting Singapore is actually long overdue. And so I don't think that the investing fraternity should be punishing them for it. I think it's long overdue, and I think prospects still look quite good for the group, for Genting Singapore.
Got it. So we have a buy with a $1.01 target price. Thanks, Samuel, for joining us.
Thanks, Dylan. Yeah.
Let's quickly go down to our trading guys, chart guys, trading ideas. We've got SEMBCORP Industries. He says that a breakout is imminent, potentially driving the price to an all-time high. So do have a look at the chart there. And he also has OILTEK International, which is a trading sell. He thinks that the bullish momentum may be fading for this stock, so and profit taking could resume. So do have a look at those charts. In terms of events and dates, we still have a few more results coming out. Big one today, Singtel, on the so not today, but on the 22nd of this week, and SATS as well on the 23rd. So if you want to figure out a trade war play, that's probably one name to have a look at. We also got GDP out of Singapore on the 26th. And then finally, we've got a very exclusive corporate access event on the 22nd of May. Takral Corporation, who has investments as well as different businesses from beauty to drones. We have the executive director and CEO presenting, so do sign up for that by scanning the QR code. With that, that's all the time we have today. Thank you so much for joining us. Have a profitable trading week, and we'll see you next week.